Rocking and rolling. It's that time of the week. Sitting down, talk to our buddy Zach Abraham, Chief Investment Officer, Capital, friend of the show, sponsor of the show. It's always a crazy week in the investment world, man. And I look around and I'm never sure what's going on because I just don't, even watching, was it Jamie Dimon that came out, was it yesterday, and said, yeah, I don't think people have any idea what the market is really about to do. And you've been saying that for a long time. These people they're high on buy, and there may be a buy in their world in the future.
Yeah, I was just telling you off air, we just hit an entry year high. Now, it doesn't mean we're going to finish there, but either 9.5%, 10% up on the year or something like that. And it's like I said, it hasn't been very chaotic or heroic or anything. Owning some precious metals, and came into the year owning, having far more exposure to international. And it really is a bizarre setup, okay? Because here's the situation. You have a stock market that is historically overvalued when you compare it to the rest of the markets around the world. It's the longest bull market in U.S. history. It's the biggest bull market in U.S. history. And, for the last 15 years, it was the only game in town. But, everything runs its course. And it's, I think a lot of us know the ridiculously priced stuff in the market, like Palantir, which is trading at 90 times sales or something like that. But, the issue that you have right now in America is that you're either buying, there's two kinds of investors right now. If you're still piling into U.S. stocks, you have to think that valuations and fundamentals do not matter. Like, let me give you for instance here. Costco, and there's a bunch of these, and there's a bunch that are more overvalued, but Costco, great company, excellently managed, all that kind of stuff. Costco's trading at 61, 62 times earnings. Okay. When you look at the shareholder yield on that company, meaning they're trading at about a $470 billion market cap right now, 450, I think 456, if I remember correctly. So let's say you just bought their company, right? The money you would make from owning them would be the profit they create, right? Well, that profit coming off of their company, they're about a $456 billion market cap. They're doing about $7.2 billion a year in profit. Okay. For those scoring at home, that's like a 1.6% shareholder yield on a company that's growing at 6.5% a year that has 2.7% margins. Okay. I don't expect every listener to know exactly what that means right off the cuff. But what that means is if you buy Costco today and it continues on the way it currently is, you will make less money as a shareholder than you will buying a 10-year US Treasury by a significant amount, right? And it's not my opinion, it's just the math. Meaning there is what we call negative risk premia on these stocks. That's how expensive they are. Meaning you're going to get, you are slated. You see, the reason you buy stocks and we don't buy CDs and bonds all the time, the reason we buy stocks is because the expected returns off of stocks are typically in excess that of fixed income. And that's what we refer to as risk premium, meaning we're getting paid more to take risk. But if you look at so many of the stocks in the market right now, and you don't look at their PE ratio, you don't look at their earnings, but you look at them as a company that you own, and you factor in their shareholder yield, what you're seeing is a lot of stocks out there trading, and a lot of the most popular stocks trading with negative risk premium, right? Meaning the forward expected return based off their own numbers is less than half of what you can make in a 10-year Treasury, which is just insanity, right? So literally you're sitting there going, I want to make less by, taking more risk. And, I don't know if people are paying attention to that at home, but that's never a good idea. No. Right? That's not what we want to do. So I've got
who's driving the market, dude?
Man, that's a tough one. The biggest thing driving markets right now, in my estimation, is deficit spending. Okay, so deficit spending and retail investors. Okay, so you've got to, and the only reason, and I agreed with 100% of what Jamie Dimon is saying. He's like, guys, regardless of what happens here, we come out the other side worse off on a profitability basis and a trade basis than we were a year ago. Why that is bullish for multiples on stocks, I don't know. Right. And then so the deficit spending, if you weren't running deficits this big, I would think that a recession is a lock. And if you looked at the Philly Fed data that came out today, data was horrible. Once again, the data just looks awful across the boards. Right now, the interesting thing is to see if you can go into recession running 7% deficits. But here's the thing you worry about. You look at Brazil right now. I think Brazil's running, it's either Brazil. I think it's Brazil. Brazil's like, pseudo third world country. They're at 10% deficits to GDP. If we go into recession where we're at right now, we'll be looking at 9 to 10% deficits to GDP. So deficit spending is unquestionably driving the stock market right now. I do think it's fair to point out, and I think it's noteworthy to point out, the stock market, I think, is up 1% or slightly less than that this year. So it's not really going anywhere, which again, isn't surprising considering earnings outlooks and current valuations and all that kind of stuff. But here's another one. And we've been talking about this all year. International markets hit another high in comparison to the US this year. And they're still dirt cheap. And people still aren't making the move. And
is that one of those things where other money managers, most people that deal with just the regular retail person, that's not their jam. They invest solely in the U.S. markets. Even thinking about going somewhere else would be almost too exotic, right? The difference between hot sauce and ketchup.
No, that's new. So here's the crazy thing. If you go back to 2010, 2011, 2012. Modern portfolio theory. Now, there's all kinds of problems with modern portfolio theory, but generally speaking, a proper portfolio was diversified. You had slivers of emerging markets. You had some precious metals. That's normal, okay? That all morphed over the last 15 years. That's how the United States market got to 70% of GDP, 70% of total global market capitalization. And I've got buddies around the world. I got a couple buddies that manage money out of Puerto Rico, Canadian buddies that manage money. I've got a buddy of mine that manages money out of Monaco. You talk to these guys, and every equity manager around the world is loaded up into U.S. equities because it's been the only game in town. But guess what they're all starting to do? Diversify away. That's why Poland is up 40% on the year. You look at, again, out of the list of the top 40 performing markets in the world, the US ranks 30. And Chad, it's probably only going to start. Here's the other thing. Because of what those governments have done, and a lot of it hasn't been very smart in terms of, they should have been doing things. And I think we clearly went overboard, but they should have been doing things over the last 10 to 15 years to stimulate their own economies. Okay, they didn't. But here's the situation where we're running 120, 130% debt to GDP and 7% deficits. Germany's running 2% deficits with 65% debt to GDP. So they're doing fiscal, right? They're doing stimulus spending. So guess what money's starting to do? It's starting to chase the stimulus, right? And to answer your question, the other thing that is driving U.S. markets is this. It is the same thing that was driving it in 99 and 2000, and the same thing that was driving the housing market in 06 and 07. Okay, it is over-levered retail. Funny story. My buddy that I was talking to today, and he's been published by Zero Hedge, Bloomberg, ran a hedge fund, very smart guy. He was talking to his dad. His dad owns his house outright. Okay, he doesn't own any money on his house. But his dad took out a HELOC and put the money in the S&P 500 in the last 6 months. And the reason he did that is because all of his buddies at the country club were doing the same thing. We look across the board, retail has record levels of leverage and margin debt on the balance sheet. So what you've got is a scenario where every, retail has been convinced the stock market can't go down. And for a long time, it couldn't, in the sense that you're running quantitative easing at the same time. Fed's got rates at zero, right? Fed's going to step in and add liquidity anytime there's a bump in the night. And you kind of effectively had this ratchet underneath the market. Okay, but now it's completely different, right? Now the US has become, like I said, by far and away a record. 70% of global market capitalization is here in the US. You're in a situation now where, like we told you, we thought the Fed was going to disappoint with rate cuts this year. And the reason that they're backing off the rate cuts is they're afraid of losing the long end. Meaning, one of the reasons that people are freaked out about US bonds right now is because of the deficits and the debt and the fact that they're not seeing us rein in spending. Well, if the Fed cuts rates, that makes that problem worse, right? Because it gives the US government a green light to take on more debt. So what happened the last time Powell cut rates last year, right? What happened? The 30-year went up. The rates on the 30-year went up, right? I think we were getting a preview there that global markets are sitting there saying, look, guys, The only way we're going to put a bid on your long-term bonds is if we start seeing fiscal restraint. If we see you going the other way and trying to stimulate more, considering where you're currently at, because the bond market's freaked out, right? They don't want to buy a bunch of duration right now. Watch the US go into recession, then watch us start stimulating again, push the deficits to 10%, watch the dollar plummet, watch the yield soar on the 30-year. They bought it at 5, now it's paying 7. Now their 30-year treasuries are sitting on a 25% loss. Right. So that you're in this perverse situation. And ironically, I'm going to tick some people off when I say this, but I think Powell's right. I actually think Powell is doing Trump a favor, meaning if Powell were to cut right now, I think the front end of the curves, 30-day treasuries, 1 year, 2 year notes, probably even 5 year, they'll fall because they're totally dictated by the Fed funds rate, right? But the back end of the curve isn't. I think that you'll see 30-year. I think if he cut right now, I think you'd see the 30-year yield go to 5.5, maybe even 6. And you push the 30-year there, you're looking at 7.5%, 8% mortgages. I mean, it's not perfectly correlated, but that's probably where you'd be sitting. Now, okay, so you're in a situation now where the Fed is sort of kind of in a corner, right? The only way they can cut is if they see material deterioration economically. Okay, so they're not coming to the rescue, right? It looks like it's going to be sort of political fisticuffs to get any of these budgets through, right? Meanwhile, foreigners are cashing out of our markets every single day. Today was yet another day. Everybody's excited about S&P. Like I said, divergence between performance of foreign markets in the US hit another high today. And I'll tell you, man, and here's the frustrating part about it to me. I'm not sitting there trying to be too smart for school and trying to time markets and all that kind of stuff. What I'm trying to wake people up to is the portfolio you currently have is not normal. It isn't normal to be all US stocks. It never has been. That wasn't modern portfolio theory. The reason that you're all US stocks is because any advisor that wasn't was bleeding clients, right? And so what do? They all capitulate, load up on Amazon, Microsoft, Nvidia, Costco, all that kind of stuff, right? Because they can't miss out. And meanwhile, in my opinion, they're missing the greatest value buying opportunity we've seen in a generation. You're looking at these people just paying ridiculous prices for US equities. Meanwhile, there's fire sales all over the world and people are just giving it away. But you're starting to see inflows into those markets, just like we were talking about. And when we're looking at the situations we're looking at, which all of them point to dollar weakness, with dollar weakness, you're going to continue to see outflows out of US markets. And people need to realize it's because of those inflows to where you are, right? Costco shouldn't be at 60 times earnings. Apple shouldn't be at 33. These companies shouldn't be there. The reason they're there is because the movie theater is freaking packed. Right? Like that's the only reason. Now investors are looking around going, wait a second. It looks like the long-term bull market on the dollar has broken. It looks like the US is in danger of losing the back end of their curve. The Fed can't jump to the rescue anymore because that might lead them to losing the back end of the curve. Meanwhile, I'm looking at US stocks that have never been more expensive compared to the rest of the world. And I'm looking at the rest of the world equities going, they are generationally cheap. Their governments don't have the fiscal restraints that the US does, and they're starting to print. It seems like a great time to pick up your stuff and head to the next party.
Amen, brother. Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. People want to join you. You got a big webinar. What do they do? How do they do it?
Yeah, hey, coming up Thursday, May 22nd at 3:30. And don't rope you into anything. It's about 45 minutes long. We just run you through who we are, what we do, and how we do it. We're going to talk about some interesting things this time. Going to talk about, we've got special ways. We've got a lot of folks around here, tech area, that have got big amounts of stock they're sitting on, single stock exposure. We've got ways for them to, first of all, insulate that against loss. Because if you got 60% of your portfolio in one stock, we got to make sure we have some protection. But also sell some of it and create an income stream off of it without triggering cap gains. Okay. So we're going to talk about that in addition to the impacts of tariffs, how we do, what we do, who we are, all that kind of stuff. And if you're interested after that, you can schedule a call with me or one of our advisors. If not, hopefully you leave more educated. So you just go to bulwarkcapitalmanagement.com, sign up for it again Thursday at 3:30. And yeah, Bob's your uncle. We'll get you squared away.
Sounds good, brother. Good talking. You kick some butt. We'll talk to you soon.
Hey, fun talking to you as always, Chad.